Welcome back to We Get Mac. We're going to continue to learn about money and banking, and especially about the money creation process which banks participate in our economy. Okay, so if you have not done so, please stop right now and watch this video of Margin Revolution University. It's extremely helpful and it's really going to help you understand this concept before we dive into this here. Okay, so moving forward, the role of banks, just to summarize once again, remember they are financial intermediaries that participate in the loan market by connecting borrowers and savers, and also by selling loans, as we talked about. They facilitate transactions by clearing out checks, right? They also contribute to the money supply process we're going to talk about here. They help with monetary policy transmission, which we're going to talk in the chapter for monetary policy. And potentially we can argue that they could help financial literacy, but as we saw in 2007, banks tend to take advantage of people that understand how the market works. And this is one of the reasons that I resent saying that they are doing their job at that task. Okay. Another important thing to say is that here we're going to focus on the creations of sovereign money, public money, which is created by the central bank. Okay, and not by private monies, which would be the case of cryptocurrencies. Okay, so in this case, we're really going to focus about how those banks, which are private institutions, right, and shouldn't be able to create money, they play a special role in our economy, and they're able to actually increase the overall money supply through the money multiplier, which we're going to learn about now. Okay, so here's an example of how things work. Okay, this is all based on the idea of the reserve requirement ratio, right, which requires banks to keep a certain amount of money and then they can loan the rest out. So imagine here we're assuming here that we're in an economy with $0, so the economy, there's no money in the economy. And there are several banks though, and the central bank decides to inject all of its money into Bailey Bros Building and Loan Association, okay, which the president is George Bailey, okay, and these examples come from A Wonderful Life, just to give us some context, right? It's not exactly from the movie, but the characters and bank names, okay. So let's say the central bank then increased the money supply by $10 million, and that's going to go to George Bailey's bank. Okay, so now he has $10 million in terms of deposits, right? And he has $10 million in terms of reserves, because right now it's just a piggy bank. He hasn't made any loans out, so it's not earning any interest, right? Okay, so he better do something about this to be able to allow this bank to earn a profit, right? So what does he do? He looks into the reserve requirement ratio of the Federal Reserve. He sees that it's 10%. Okay, so he must keep 10%. The bank must keep 10% as reserves of its deposits, and it can loan out the other 90%. Okay, 90% of $10 million is $9 million. Okay, so now the $9 million, let's assume that it's a loan to a single company, which is the Hank's Auto Supply. Okay, and let's assume that Hank's Auto Supply banks with the rival bank, which is Mr. Potter. Okay, so by loaning out those $9 million, now George Bailey's bank can make some money, right? It is working as a financial intermediary as well. But more importantly, we know then that Hank's Auto Supply, before maybe they spend that money, they deposit that money into their bank until they get their expansion process into place, which might be why they borrowed that money, right? So now what happens? Well, the rival bank now gets $9 million, which now are $9 million in deposits, and before it loans out, it has $9 million in reserves as well. It's playing that piggy bank role that we talked about. Right? They also want to make money and be profitable, so they look into the Federal Reserve requirement ratio, see that they have to keep 10% of that into their assets, and they can loan out the other 90%. Okay, so they're going to do exactly that. So now Mr. Porter has to keep $900,000 into their reserves and can lend out $1.1 million. And this is the idea that now he's going to lend out $1.1 million, and then that's going to be deposited to another bank, and that bank's going to make another loan. That's the idea of the money multiplier and the creation process related to how the banks assist in the money creation process in the US. Okay, so this is all possible due to this fractional reserve banking idea, right? That banks are keeping just some part of those deposits and lending the rest out. Okay, so let's summarize this into maybe one slide so we can get a better idea before we move forward. Okay, so original bank deposit was $10 million to bank one. They must keep 10%, right? Oops, sorry about that. Didn't mean to do that. They must keep 10%, loan down 90%. Right? Then bank two, assuming that bank two gets all the deposit, the bank two then has to keep 90% as well, right? It can loan down 90% as well, but it must keep 10%, right? So now bank three are going to get $8.1 million as deposits. They can loan out 90% of it and keep 10%. If they loan out 90% of it, that's going to be $7,290,000, right? And this process is going to keep going because they're going to loan 90% of that out to other banks and so on. Now, if you keep doing this all the way until there's no money left in the economy, you would get the result of $100,000 million. Okay. Feel free to do that on your own. I incentivize you to test mathematical proofs and mathematical equations and formulas, because what's the point of just believing things? You make sure you understand why these formulas are put in place, okay? But it's exactly what we're going to talk about now, is that how can we more quickly get to this idea of the overall money supply in an economy, okay? It's to the simple money multiplier, right? So it's the rate at which a bank activity multiplies the money supply when assuming banks hold no excess reserves. So the biggest thing here you can see is that, is this the case? Can a bank, does the bank always hold exactly the same amount of reserves that is required by the Fed? Not always, right? Depends on a lot of things. And we're going to discuss those things in a second, okay? But if banks hold more than they're required, then you definitely know that now this money multiplier is going to be impacted, okay? How so? Well, the money multiplier here, you can see it's the formula of 1 over the reserve requirement ratio, which, remember, the reserve requirement ratio, it's done in decimals, right? So in this case, this is 0.10, okay? So in this case, we could do 1 divided by 0.10 to get what the money multiplier is. And if we did 1 divided by 0.1, we would get that it is 10, okay? So that way we can then estimate what is the overall money supply based on that, that initial money supply that is dictated and it was imposed and released by the central bank, okay? So in this case, what we would have done is, hey, how would I solve this, Eddie? I would have given you a reserve requirement ratio, right, of 10% that we know. You would know the money supply, and then you'll be able to calculate the money multiplier, which then allows us to calculate the total money supply. Okay, so you saw here we have our initial money supply, $10 million, right, times 10, the money multiplier, which came from this assumption that banks are going to hold what is equal to the reserve requirement ratio, right? And that leads us to a maximum upper bound on the maximum amount of money that can be circulating in the economy given the requirements for reserve requirement ratio. Okay, so what's the idea here? With a simple graph, as you can see, a $100 bill has to be capped 10%, and we keep loaning that out. Just once again, illustrating that process with less than $10 million, right? So just kind of simplifying a little bit more in case those numbers scared you. Okay. Now, please take a moment right now, and I will solve this exercise in a second, in probably the next video because of the time, and you'll be the last video for this chapter. So take a time right now and try to solve this exercise, and we can close the chapter on Money and Bank for the next video. Sounds good? I'll see you guys in a bit.